property with Rethink Investing.
Australia's largest and most comprehensive podcast covering all things commercial investing.
Hi, good everyone. How you going? Phil Tarrant. I'm the host of Inside Commercial Property with Rethink Investing, joined by Scott O'Neill, Director, Founder, Rethink Investing. How you going, Scott? Well,
mate, good to be here again.
It's good to see you, mate. And I've been curious about what you guys have been up to recently. You always got something in the wings, and you mentioned to me a couple of months ago that you're sort of nosing around the New Zealand market and you see sort of great opportunities out there. So it's going to be a main thrust for our conversation today. What's going on in NZ. But before we get there, mate, any updates on the Aussie market? More of the same? Any significant shifts, any changes?
Yeah, so it's tight. Basically, the theme is stock seems to be lower and lower. From an everyday person point of view, like where we're dealing with, that's sort of like the $1, $2, $3, $4, $5 million price points. They're almost as tight as I've ever seen them. Sellers are just not selling. There's huge demand for, say, industrial sheds around 5 mil. It's very hard to find a good deal at the moment. Probably the hardest it's been since we've started this podcast, which is interesting. So I think the lack of an interest rate cut is meaning sellers aren't keen to test the market, and there's not much reason to sell if you're already in the market where you're going to put your money. I don't know. It's tight. So we're seeing growth. Yields are getting better in some areas to contradict that comment, but that's more so like increases in yields in, say, the CBD markets. Sydney is a market now where we're actively buying in above 6% net almost weekly or every second week at the moment. That's almost the best yields I've seen since 2017.
Tell me about the best deal you've done in the last month.
So we've done a lot of medical centres in terms of probably one of the best, like North Brisbane location, high 6% yield, 10-year leases, new building, really good asset. That was about an 8-9 mil type price point. You can get lucky with industrial assets, sort of 2, 3, 4 mil if you go a bit regional, and you can see there's often 20% upside in them. Everyone wants those though, but they're quite rare. We're looking for an office for Rethink around Sydney. I was talking to our guest, Todd, just before about differences in the office markets. Like a premium office is so hard to find at the moment. But secondary office, the lower quality stuff, they're there for days. There's so much selection, they're not going to fill them, basically.
I was chatting to a guy this morning. We were recording this in North Sydney. He said he just did a lease deal in North Sydney, already completely fitted out, brand new fit out, but hasn't been used for the last 2 years after post-COVID. So pretty much brand new fit out, straight into it, 40% incentive on it, all cash. I was just like, 40% sounds high. Like they've obviously manufactured up the price to give 40% away. I thought that was big though.
Well, when I saw walk into your office here today, there was 4 lease signs on great corner location, street frontage, around the east, that doesn't exist, for example. So there's a lot of stock around North Sydney at the moment. And
this is the centre of the world now, mate. You're getting the train stations coming in, and there's bars and discotheques opening, sort of place that you'd frequent on a Friday night.
Discotheques. I like it, mate. Discotheque.
Anyway, we're not here to talk about
I was going to say, don't show your age, but
no. They're always going to be called a discotheque.
Different generation.
But we're not here to talk about the Australian market. We're here to talk about New Zealand, and I know you guys have been acting and operating in there. So I know you scratched your head and you explored the whole of the New Zealand market to find us a good guest. What you've come up with.
You ended up with me, is that what I was saying?
With Todd Lauchlan, who's the managing director of JLL New Zealand. That's Jones Lang LaSalle. So we're scratching the bottom of the barrel. Number one, getting a Kiwi in, and number two, the guy that heads up Jones Lang LaSalle in New Zealand. Welcome to the show.
What an introduction. Thanks.
Well, I know you're probably a bit nervous because there's probably more people tune into this podcast what there is population New Zealand, but
I've got more sheep though.
Maybe.
I had to get that joke out earlier, didn't know about the sheep.
No, thanks, mate. I know you're super busy, and thanks, mate. Have you come out just to do this, or are you out here doing other stuff?
No, I'm here for a couple of other reasons. So I've got a client looking to sell an asset in Tauranga, which is part of our Golden Triangle, and we've got another client of ours in Wellington who's looking at selling a big land parcel there. So busy doing all that other stuff, but great to see you and Scott. Actually, listening to you talking about the market, it felt like I was back in time, about 12 months, because we're probably a little bit further ahead with our interest rates being so high over the last sort of 18, 24 months. It's really put the squeeze on. So both the general economy and I think some of our vendors are probably a bit more motivated.
I think, before we jump on, the interest rate is one of the main reasons I'm seeing there's great opportunities for New Zealand, because they went up a lot higher than us. Like, what are you sitting at? 5.25.
Our OCR is 5.5.
5.5.
Yeah.
That's a lot higher than ours, and you've had bigger price corrections. And the talk is interest rates are going to come faster and harder than Australia. So there's a faster improving situation there than Australia. Like, we're not going to get our rate cut as soon as we wanted.
Well, they reckon middle of next year. Depends who you listen to now. But the last time I was actually in New Zealand was in March of this year, and I think it was the day when New Zealand formally went into a recession. I remember that was a headline for me. And I want to sort of touch on the economy a little bit, because as what myself and Scott chat about all the time is commercial finance, or commercial property is directly and intrinsically connected with business, right? And economic health of the nation. So what's it like out there at the moment? I'm out there again next month, so I'll get a read of it personally. But
it's tough.
Yeah.
Legitimately tough. There's actually really a lot of pain out there. In the household sector, in the business sector, we've had a per capita recession for probably 2 years now.
Yeah.
So we've had a lot of immigration, but on a per capita basis, our economy's been going backwards for probably about 18, 24 months. We've got, consumer spending's been down for 8 quarters in a row. So it's been a tough operating environment if you're a retailer. But there's, obviously good businesses performing well. Yeah. We've still got demand coming through in immigration. There's still aspects of our economy that are going fine. Change in government, which is a big piece as well. So we've obviously pushed to a coalition which is much more business friendly, but they've been delivering a lot of cuts across the government sector. So that whole piece is really coming through, and that's actually meant that we've got our CPI number right down to, that was, I think, at the peak 6.5%, 7%. The most recent reading was 3.3, and that's meant that all the banks now, all the major trading banks, are saying we're calling the market down for interest rates. So likely to have a cut October, November, and might see as much as 200 basis points of cuts over the next 18 months.
200 basis points,
which is a big dial mover for the commercial market. So that's, from a buying point of view, if you're thinking you've got your buyer's agency hat on for your client base, Scott. There's probably a significant opportunity out there still. And it has been very tightly held, particularly that industrial space. Yeah,
we'll get into the different asset classes. I was just trying to get a holistic view of things, because I'm quite dialed in with the New Zealand market. I like Kiwis, you're good people, despite the fact that we don't always see it always. It's all good. And I know our market's much larger than yours, but there is a commercial market in New Zealand, isn't there?
Absolutely. Yeah.
So you said that some businesses are doing well, some doing less well. So
sure.
What sectors of the economy, from a business point of view, are really performing at the moment? You've always got, the resources sector normally performs sort of okay, but...
Yeah, I think, underlying our economy has always been agriculture. So, the dairy price is very important for us. What we sell our sheep and beef for is very important for us. We've got a big forestry sector. That's always important. And obviously with the Kiwi dollar being low, commodity prices, have been relatively strong, so that's been doing fine. Big piece of our foreign exchange earning is tourism, so that still hasn't got to where it was in 2019. So the Americans are above where they were. Australians are as well. So we've probably got 20% more tourists coming from Australia or America than we had pre-COVID. But we haven't had the Chinese
tourists coming in.
Just haven't had them back. So that's had a bit of an impact. But I would say, if you're talking about where it's tough, retail. Car sales down 40% year on year.
There's just less dough in the economy. People are doing it tough.
People haven't got the confidence. I don't think there's a question of actual necessarily the ability to pull the trigger on a big purchase, but it's just not having the confidence. And that's coming through in the employment numbers too. So you've got unemployment starting to sort of jump.
I saw a stat out there from UBS. They were saying the Australian economy's got 8.4% saved up cash versus GDP, but New Zealand was about 1.6.
Okay.
So they got far less cash in banks, and a lot of that would be to do with what's happened with the property market. The interest rates kind of sucked it up more, because a lot of them said they went too hard, didn't they, back in the day? But now you're going to get a rate cut quicker, so. It's different perspectives, really.
A lot of our saving is in the residential housing market. So a lot of the, I think the boomer generation, let's call them that, and even so much, I think probably even our generation, those of us in the 40s and 50s, have put money into residential property. So the saving rate probably doesn't necessarily represent the asset base. But we don't have a compulsory super. We've only got voluntary super, so we don't have that industry as well. So.
Yeah, I guess it's a sort of sentiment or a confidence level in that if most people have their wealth tied up in their resi property, their principal place of residence and or investment properties, and property hasn't performed like it has done. If you're in the market 10 years ago in New Zealand and resi property, you probably did pretty well. But if you were entered the market the last couple of years, you're probably not feeling that wealthy at the moment. You know, people are preserving that and probably not actioning it. So, you know. But commercial property, what's the transition really like? You know, myself and Scott on this podcast, Inside Commercial Property, chat a lot about the journey of most people's wealth creation through property. They start buying resi stuff and they eventually end up in commercial for whatever reason, which we speak at length. Is it consistent in New Zealand? Is it resi property investors become fatigued with, you know, managing large portfolios and pretty lackluster yields, and they go, need to start thinking about something a bit more longer term?
I mean, yeah, absolutely.
Yeah.
That would be I think those that make the transition probably adjust to the risk, have to understand the market a bit more, have to be a bit more, I guess, professional in their approach. But that would be the transition. I mean, and most of them would go from 1 or 2 or 3 residential properties, look to sell 1 or 2 of them, and then migrate into a commercial property. And obviously the yield comparison, you literally get double the yield in a commercial property than you would a residential, but maybe even more. So
tell us about JLL out in New Zealand. I think most people, if they're in and around commercial property in Australia, they will be familiar with the brand. It's a large organisation. Do you do what you do here in Australia in New Zealand? Like, give us a sense for the scope of the business.
We actually look at our business as Australasian.
Okay.
So we've got 4,500 people here in Australia, 180 in New Zealand. So you can get a sense for the scale. Much smaller business. We offer most of the same service lines. We don't do property management on behalf of our clients in New Zealand, but everything else we pretty much do. And we do lean heavily and work really closely with our Australian teams. We just have to. And that we think that's our competitive advantage, just tapping into that, both from a client point of view. So if you think about the big occupiers, the banks, the insurance companies, most of them are actually Australasian, or they have a headquarter in Sydney or Melbourne. Or if you think of the landlords or the big investors, they almost certainly come into Sydney, Melbourne, Brisbane, and they start thinking about Auckland, Wellington, Christchurch, whatever.
Yeah.
So, we kind of think about, we just match our business to our client base.
And you sort of average JLL sales agent out in New Zealand at the moment, they walking around with their shoulders slumped and, you know, the sky's falling in, or they got a bit of spring to their step?
I think they've got a bit of a spring to their step, actually. I mean, it has been tough. I'm not, no question around it. It has been tough, I think, for the entire market over the last 18 months. But the last 3 to 6 months, I think most people can get a sense for where things are turning. So, almost bad news is good news for us. Yeah. So if you have a bit of stress and strain and people are thinking, well, maybe it's time to sell, or they have put off selling, they're more likely to come to market now when they see a bit of hope on the horizon. And that's certainly the case in terms of what we're seeing, in terms of what's being listed. And there's actually a lot of inventory out there for discerning investors to pick up. And if you start to look at the forward funding curve, which is a sort of jargon for saying what will interest rates be in 2 or 3 years' time, you're pretty confident they're going to be falling as well. So if your debt costs are falling and your rent stream is going to increase, well, that's obviously going to give you that positive carry and that ability to drive capital value as well as rent growth. I
know that's what you've seen in that market, hence the reason why you're out there, and we'll get sort of into that. But we spoke about you got a new government. We spoke about some of the economic climate, the drivers of the New Zealand economy. But at a sort of more tactical level, sort of the different asset class, what's really driving? What are the factors driving the commercial market in NZ at the moment? What are you seeing that's really changing things up?
Probably the market that we're seeing the most opportunity in is that retail convenience, large format retail space. So probably like Australia, we had shopping malls or different format locations where you'd have tenants who were paying rents that were inflated and perhaps over the market. Some of the retailers were hit with online and they were under stress, so they weren't able to pay rent, and there was a bit of an adjustment. So investors were concerned about going into that space. Now you've seen it, all those rents have reset, very little new development. So supply's been constrained and the demand sort of keep coming. So your supermarkets, your Harvey Normans, your Briscoes, your Farmers, the big players in our retail space have done really quite well over the last 2 or 3 years. And that property that houses them has done really, really well. And you're getting good yields, often with large land banks, so a potential for additional development, and good locations that if you want to try and build that again or buy that land again or build that property again, you just couldn't. It'd be too expensive. So that's probably where we're seeing the most opportunity. Industrial, I think, very similar to what you're saying, Scott. You've had a strong occupier base, very limited new supply, vacancy rates really low, so you've had rent growth, but quite hard to get the yield.
Are you finding developers can't make margins too because of that build replacement differential at the moment?
Yeah, so we've probably went through a period of time 18 months ago where the tenant would say, I'm happy to pay that new number to justify the build cost. There's economic rent there, and that lifted everybody.
Yep.
I'd say right now in the current climate, that's not happening. Okay. Or if it is happening, it's only happening for a few. And the owner-occupiers have probably got their foot off the gas too, so that's probably the opportunity for those savvy investors who are prepared to take a step in. They can get a good yield and some capital gain. Office, the best stuff does really well. And yes, like you said, the secondary office space is struggling and will continue to struggle. So if you haven't got great location, really high quality tenant amenity, you haven't got a very proactive landlord who's really focusing on the clients, you'll struggle. But those who have are doing all those things, so the big listed groups, the big syndicators, the players that really are quite sophisticated and very local, they're doing well.
Yeah. I was going to ask you who's holding these blue chip assets. So you have these sort of big syndicates and listed players. In Australia, obviously, our super funds own all the blue chip assets. What's the sort of client base that Scott works with, which would be sort of a couple $1 million to probably 50 to 100, right? I'm sort of generalising there. Like, what does it look like in New Zealand? Have you got a lot of private investors buying that sort of stuff?
Yeah, so very similar to Australia by the sounds of it. Yeah. So that sort of 2 to 10 to 15 would almost exclusively be privates. Then you get above 10 to say 50 or 10 to 30, a lot of syndicators operating. Yeah. Unlisted funds.
Like real structured syndicators?
Absolutely. And we have Centuria, for example, who are both obviously big here. And local players like Oyster, PMG, Macasee Properties, they're all very sophisticated, large, more than sort of $2-3 billion portfolios of syndicated assets that they've got for different groups of investors. And then when you get above that, you've got the listed groups. Yep. So, Precinct, Stride, Argosy, amongst others, who are on the share market with, and most of them have got, majority of them are focused on a particular asset class. Yeah. So Goodman, for example, and they're listed, they're the most successful industrial. Them and PFI are probably our two biggest industrial funds.
Those big listed players, are they active at the moment? They're sitting on their hands?
They're starting to do things. I think probably even in the last few weeks around the interest rate changes really changed their thinking because obviously they've all pretty conservatively geared. So as soon as you start to think that the interest rate costs might change, then they can start to think acquiring. Yeah. And likewise the syndicated. So I'd say it's probably just starting to move. But most of them have had big development pipeline. So they've had clients who they're building buildings for or they're actually investing in their existing assets to upgrade. So there's always stuff going on, but probably not that active on the acquisition front.
What about sort of specialty stuff? Is that like, you spoke, you've been doing some good deals doing medical type assets. Is the smart money in New Zealand at the moment in the industrial stuff?
It has been historically. Yeah. I think there is purpose-built student accommodation, purpose-built medical facilities. I'd say is a sector that's really got a lot of opportunity. Okay. So because we've got real challenges around healthcare, property, just having the right facilities, we've got deficits in that space, and we're getting a lot of students. I mean, I think it's the same here, right? You've almost, in fact, the politics around that is almost a bit controversial, isn't it? Almost too many students. Yeah. So, I would say each of our universities is looking to build more student accommodation.
Yeah, they need it, right? It's such a revenue driver.
They need it. I mean, without the accommodation, people just won't come.
Yeah, it's our biggest export outside of the stuff that we dig out of the ground.
Well, and, the comparison is almost like for like. It's just that you've probably been, I think, Sydney, Melbourne particularly have been very successful, and we've got a bit catch up.
Yeah. And you spoke about the Golden Triangle. I must have been, I'm not that familiar with specific markets inside of New Zealand, but I would say that it's probably a little bit different in Australia because we have Sydney, Brisbane, Melbourne, massive, big capital cities. In New Zealand, you'd have Auckland and Wellington, you're probably two bigger cities. But then you've got large... And Christchurch. Then you've got sort of larger regional areas like Dunedin and
Hamilton,
Gisborne, Hamilton, all these sort of places, right? Does it matter where you're investing in New Zealand in terms of commercial property?
Look, I think there's opportunities everywhere. I would almost compare Sydney to Auckland.
Yep.
And Melbourne's probably a bit more like Christchurch. So flat, lots of land, so hard to get the rent increases, hard to get the capital growth because you can always go and build a facility up the road. Where in Sydney, eastern suburbs, tightly held. Auckland, our Auckland areas are very tightly held, so you just can't get the land. Your construction costs can be quite expensive. The demand is there, but so you'll probably get more capital growth. So you trade off a lower yield for a higher cap growth in those locations. So Hamilton's probably more like Melbourne and Christchurch, so flat land. So it does come down to where you want to buy, whether you want a good solid cash flow and not so focused on the capital growth, or whether you want a bit of both. Mm-hmm. So what we're finding is we don't have capital gains tax in New Zealand, right? So that's another reason why often the property deals that are done are actually more focused on that capital gain.
Yeah, and that's encouraging to know. It might be attractive mechanism for Australians sort of operating out there. But I guess out in New Zealand also, you've got places like Christchurch, you've got issues with like earthquakes and stuff like these environmental factors. Does that change the playing field?
It definitely does, and I think you'll find that, Christchurch almost had to be rebuilt. Mm. So, over the last 12, 13, 14 years, the city's been rebuilt. So you've got a whole lot of property that's brand new, absolutely fit for purpose, fully at code, well leased, to the clients that you'd be very comfortable with. Whereas if you've got an older property, then you have to do your homework. And I think part of your process, no doubt, is going to think about seismic.
Yeah, get the engineers out, and because it affects lending and everything, doesn't it? It's like a flood zone for us in Australia. There's restrictions, and if you get the wrong building,
postcode restrictions, you're stuffed.
Yeah,
right.
You actually can't get lending.
Yeah,
if you haven't got the right seismic, it's called a detailed seismic assessment, which is the engineer's vernacular for a report that the bank will look at. If they haven't got the right rating, you won't get the money. Mm. So that obviously means you've got a market where it's new at code that trades at this level, and then you've got a market that sits below that. And I think that's probably a big
similar to Brisbane in a way, isn't it? Like you've got your flood industrial areas, and then the non-flood. There's about 1% or 1.5% difference in yield just between the two flood risk rates.
You don't touch flood-prone stuff? No.
Look, on occasions we buy in a technical flood zone, but you can get surveyors out and prove it wasn't ever flooded, because they did put a factor of safety on the maps in areas, so you can get a harsh rating. But nothing that's got wet to the point where the roof's underwater. Like never. Yeah. It's just not worth it.
Well, you said about yields, and I'm just curious. I know you've spent quite a lot of time outside of New Zealand, in Asia. How different is the market from what you see in other parts of the world from a yielding perspective? Is it pretty much the same as everywhere else, just a bit more of a smaller market? I don't want to generalise, but I'm just trying to work out how different it is out in New Zealand.
New Zealand's more like Australia than the markets I was at. Yeah. I would say, as a generalisation. I was sort of emerging market, so I spent 7 years in Indonesia, 4 years in India, 18 months in China.
Okay.
So the investor base there that was buying in property would often buy for a yield significantly lower than they can get in the bank, and they would almost very rarely get any debt. Yeah. So I can't even try to start to explain that to you, but mostly there was different reasons for buying, and it was linked to the capital gain and obviously a bit of an inflation hedge.
So what type of yields would you get in, Indonesia, generalising versus New Zealand and India?
Jakarta office, I think you'd probably still be at 6%.
Okay.
But your lending rate's probably 8 or 9. I was actually up there relatively recently.
So it's a capital growth play?
It is, and I think it doesn't. It's not really a rational market in the way that we think about it. It's often not a geared play for the investors. Whereas if you go to, the more comparable market is probably Japan, and I've never worked there. Mm. But you still have interest rates there. Your total cost of debt there would be sub 2, it could be 1.5, and your yields might be 3.5, 4. And you could have, so there's been a huge amount of capital deployed by all the big players in Japan over the last 18 months, well, in fact, probably 2 or 3 years. And they've all made really good returns based on the fact that a little bit of inflation in Japan has meant that the negative interest rates have gone off the table and people have gone back into property. Mm. So, it wasn't that long ago that we were talking about negative interest rates, right?
Yeah. Imagine.
So, if that's the case, I think your investors will be happy, Scott.
Do you miss the hustle and bustle of commercial property in Asia? Very different. than
I
New Zealand.
missed it, but it was
Right place, right time.
Yeah, I think so. And also, I mean, it's not just me, right? Both. Now I've got wife and two kids who went. My son was born in Dubai, and my daughter was a 9-month-old when we left to the Middle East. So, they were living their entire life overseas, and my poor long-suffering wife came with me, right? So, I was quite happy, I think, to come home.
But you can get excited about the New Zealand commercial market.
Oh, absolutely, I love it. I mean, I believe in it. I'm invested. It's a great place to live. No stamp duty, no cap gains tax. We've got opportunity there, but it's like every market, you've got to do your homework, right?
Yeah. Answer is wide, and from what I understand, your sort of expanding interest out in New Zealand, there doesn't seem to be really anyone that does what you do out there at the sort of same scale of sophistication, operating the market you operate. Well, what do you need? What do you need? Like, how much do you need to actually buy good commercial assets in New Zealand?
I think you're probably total investment, anything 800,000 to $1 million up, I'd say you could buy something reasonably good.
Yeah.
Yep.
That's affordable.
So you could, and let's say you borrowed half of that. I mean, I think I often say to our client base is that the higher you go, the more above the clouds you are in terms of what, and that's probably the same here, all right? So if you're talking 10 or 15 million, you're competing with a lot less other buyers. If you're talking 1 million, then you're actually competing with the owner-occupiers often. And investors who are potentially looking at a housing option or a commercial property. So there's probably you've got more liquidity if you want to sell, but if you want to buy, you're probably not getting the same opportunities.
And do you leave that cheaper stuff to other sort of commercial operators out there, or you get involved in?
I think some of our younger crew get involved, right through the market because they want to service that entire, and we are very patch focused. So we will look at the city and say, depending on the product type, we will split this up and make sure we've got patch specialists. So they will typically deal right through the sector, or through the value chain, through the from 1 million up.
Yeah, I imagine your $1 million probably goes a lot further in place outside of Auckland.
$1 million in Christchurch, bricks and mortar would be, I'm not sure what the square metre rates would be, but that would be significantly less than you'd be paying in Sydney or Melbourne, I'm sure.
Yeah.
And your dollar does go further. Like we've been telling clients in Australia, it's a higher price point because lending's tougher over there. You work off 50, 60, maybe 70%, but probably go off 60. So you need to bring about $500,000 over, which would be, 450 Aussie, 450 cash Aussie. So, you still need cash, and the lending is the tricky bit. But you get a pretty good asset, like comparably to Australia, for $1 million. Like you said, you go to Christchurch or South Island somewhere, or a bit more regional, and you could probably get twice the industrial shed size compared to Brisbane or some of these other eastern state areas. So it's good value.
What do you reckon about these Aussies come skulking around your commercial market?
I'm not sure.
Yeah, still got to work it out. Very parochial, right?
No, I mean, look, we're an American business.
Yeah.
We've been there since 1986. And we are. We truly think we're a global business, and we will deal with anybody and everybody. We're believers in the country. No question. There'll be some questions asked. What are these guys here? Are they serious? Are they going to commit to this market? How long are they going to be here for? But at the end of the day, we're a results business, right? You guys are doing transactions. I would say you'd be absolutely welcome with open arms. I mean, it's even sometimes challenging for an Auckland to go to Christchurch, right, or Christchurch, or something. The Victoria versus Queensland versus New South Wales. You get proclism everywhere. I think it's just the reality. Our view is that, and we've got a government right now that I would say, particularly David Seymour, who's one of the smaller coalition partners or the head of the ACT Party, who says, look, we want to open the market up to private investment. We want to bring capital. And if you're going to bring it, why wouldn't you bring it from 3 hours away rather than the other side of the world, right? So,
well, the Yanks like New Zealand these days. I think sort of post pandemic, they've gone, hang on a second, this is not a bad place to park your dough and sort of create value and also have a nice life.
Yeah, I mean, we've always had some significant players, American players. I mean, before COVID, but more so more recently. I mean, our hotel market above $10 million. 60% is owned by Asian investors, for example. Okay. To give you an idea of how much foreign money we've had historically. We've had money. We've had big overseas players in our market since the 80s. And that's just, for us, it creates liquidity.
That's what you need. That's what you want.
We need it.
Yeah.
And you can get in, you can get out. I mean, at the end of the day, if you want to put $1 in, you take your $2 out, right? You want to make sure you can do that.
That's probably a question for you. And I know you sort of you're in New Zealand, from what I understand, to sort of help Kiwis transact commercial property more effectively, but there's obviously opportunities for Kiwis to invest in Australia and vice versa. How hard is it to sort of move your dial around between the two countries?
Look, it's not hard. Most banks in Australia kind of exist in New Zealand as well. So you get onto your business bank, call them, set up an account. You can get your money there pretty easily. From a lending point of view, you can do standalone deals there. Yeah. So you can just do it off. You normally need about 1.5% interest rate cover. So if you're working off a 50% loan, it's pretty easy to get, really. Like, do a $2 million loan. You've got to cover 135 grand of net rent on that one. Sorry, if it's $1 million loan, so if you bring $1 million cash, buy a $2 million asset, you need about 135 in net rent to cover that loan, and then you're in. So you can get the local funding. We've found that most people, because we've only been there for about a couple of months, and we're doing deals every week there, but they're all New Zealanders, and expats as well. So there's not many Australians yet coming over, which is surprising. But we were always being asked for years about can Rethink help the New Zealand, because they do listen to this podcast. Because like Todd mentioned, it's such a similar market. It's we're at different speeds, different parts of the curve, different interest rates, but industrial properties are performing exactly the same as they are on the East Coast. The regional markets have their own dynamics similar to what played out in COVID in Australia. They've got the build cost issues, they've got the development constraint issues, they've got the liquidity issues out there, the low stock. It's all the same. Like, I haven't found many differences yet besides the accent. So.
Well, you can always get a translator, and we've been doing that for years. Welcome back, Phil Tarrant, co-host of Inside Commercial Property with Scott O'Neill from Rethink Investing. We've got Todd Lauchlan in the studio, Managing Director at JLL New Zealand. He's made the trip out to New Zealand to do stuff. I want to talk to Scott around accountants, and there's a whole idea of sort of cross-country investing and stuff, but we touched on finance really quickly, Todd. The bank's appetite, attitude towards sort of, not talking $800 million stuff, but sort of, more mid-tier type deals. The banks or financial institutions liking in commercial property at the moment?
Yeah, I think the banks, it's a well-trodden path. I mean, I think 75 or 80% of our market is controlled by the four major Australian banks. So ANZ, Westpac, ASB, and so what's BNZ? So BNZ, so NAB owns BNZ. Yeah.
Westpac,
ANZ, and I can't think the other one is. Anyway, it'll come to me. But anyway, they control 80% of the market, and I would say the commercial property lending sector still is predominantly through those four major players. But we've got a number of large Chinese banks who've been lending into the commercial space. So they've been quite active in the last 3 or 4 years, added a lot more liquidity. And in the non-bank space, we've got all your major players that have come in the last, I guess, 4 or 5 years, and probably before that, who have been lending aggressively in Australia and now lending in New Zealand. So, depending where you are on the risk curve and what you want to, whether we're looking at investment finance for a property right through to development funding, we've got, our guys can sort of help with that. And there's appetite. I mean, certainly I would say that there's a lot of work done behind the scenes to pick up on that economic data, like you're talking about, Phil, and saying, well, how's my risk going forward? How's the residential market going to be like if I'm selling out a development? Can I, is the interest rate going to fall? What's the strength of the covenant? Does it tick the box from a seismic point of view? All those things. The bank's pretty focused on all that and quite conservative. And I think it's served us well, right? So we haven't got an overbuilt sector. None of our markets are overbuilt. Yeah.
That's a good thing.
Yeah.
And you've got a new government, and I know the last government was quite polarising, particularly through the COVID pandemic. You've sort of given a pathway for what you think the future's going to look like in terms of interest rates and economic recovery, if you want to call it that, in New Zealand. I know the previous government sort of really more than tinkered with policies around property investment, particularly in resi, which hammered a lot of investors. I know Kiwi property investors, resi, just still trying to recover for it, and the pathway back to what it was like prior to them forming government still many years away, and the current government, the new government, is still sort of probably not being as aggressive what they would normally like to be,
Yeah, I mean,
long-term predictions? Imagine you guys must be dialed in pretty well with various mechanisms of government.
The last government, I think, that they would have some pretty big challenges around COVID, and made some decisions that were made. I think the new government, I guess, looking forward, is much more around private investment, business focus. Understand that you have to make a return, but you want to bring the investment in, and that's not just capital. That's just occupiers. That's just any economic development that can drive opportunity and growth. So I think from an economic recovery point of view and a growth point of view, and drives the demand for any of our sectors, positive. Right now, tough, because they've been cutting a lot of government government staff, particularly in Wellington's been heavily impacted there. It's a tough economy. So you really are seeing some stress and strain out there. But in terms of the sort of 1 to 3 year, 5 year sort of view, really quite strong, I think. Very business friendly environment, I would say.
Is there anywhere where you wouldn't be investing in commercial property in New Zealand at the moment? You speak about Wellington, for example, with downsides in the government, which I imagine a lot of people are saying that's the right thing to do anyway, right? It's probably overcooked, but anywhere you stay away from?
I think if you're staying, I would stay away from secondary office, and you could probably have exactly the same comment, couldn't you, Scott? Because there will be people that buy a secondary office and make money, but there will be people that buy it with a clear view of where they want to take that asset, they want to refurbish it, upgrade it, bring in new tenants, deliver a whole lot of amenity, do great fit-out deals or whatever it might be. It's a very hands-on, entrepreneurial space. If you're looking at a return with a bit of capital gain, I would stay away from that. Maybe going with someone who has a fund who might want to do that. That's fine. That would be a space I'd stay away from. But I think if you're talking industrial locations, particularly in Auckland, Hamilton, Christchurch, where the areas are already mature, there's a scarcity of land, the demand's clear, the economy's supporting that. You're buying a good property in a good location.
You've probably seen the same drivers we're seeing here around industrial and warehousing. It's just more people doing online shopping, more people working from home, still this COVID, flexible working conditions and all this sort of stuff. Like, it's pretty much another segment of the Australian market.
It is. Yeah. The difference maybe is that, for example, Christchurch, it's most people it's a 10 or 15 minute commute. There's virtually no work from home. Because if you can get to the office in 10 minutes...
You should be in the office.
You can bike or drive there in 10 minutes. Well, you just go to the office because people want to be around other people, right? That's how stuff gets done. That's how value gets created. That's how innovation works, right? So I think where you're seeing it, it's probably a bit like Melbourne and Sydney. If you've got an hour and a half or an hour commute, maybe you make the call to come in 3 days a week and stay home for 2, and you manage it by teams or whatever. But so I think it's actually more to do with the geography of the location. We have our stats for our business, so I can see who's in the office. It's anonymised, but I can see what our occupancy rates are. Christchurch, every week, 100%.
Really? Wow.
They're probably happier as well.
I think so. I mean, obviously, we're a real estate business, right? So it's pretty simple stuff.
Yeah. And you are a real estate business. How do you see your business changing in the years ahead?
I think JLL as a business has invested heavily in technology and around developing and training its people, because I think we know that there's so much change coming. So, whether that's the way you occupy your office space, whether the way your business works, we've a lot of our, let's call it accounts payable, accounts receivable, our kind of process work is done by our team, our JLL team members in Manila and India. We've got a whole team in India that's just focused on how we can leverage AI to improve our best practice around delivering whatever it might be for clients. So I think a lot of it will be around technology, but it'll always be the people piece. It's always going to be around connecting with people. I mean, if Scott doesn't trust me to sell his property, then it doesn't matter what technology I've got on my iPad or my phone or what I'm doing online. It doesn't matter, right? It's a conversation now around trust. So ultimately, and we're very much around team, and we think of ourselves in a positive way as the seventh state. So we're part of the Aussie team. We absolutely collaborate with them. We leverage that platform. Yeah. And if we don't do that, then we're failing our clients.
But it'd be silly not to do that, because you have similar funding arrangements, same banks, same market conditions largely, probably similar customers or the same customers.
Yep.
It makes sense. How have you find, Scott, sort of access to the New Zealand market from, has it largely emulated what you do here? Have they been, the fact that you've got Todd here is probably a good sense for accessibility, and JLL being a big organisation, but they've been open arms for what you're trying to do. They understand what you're trying to do?
It's been really positive.
Yeah.
To be honest, a lot better than I thought. Because I thought there'd be a bit of pushback just from, a new person entering the market. We don't know what we're doing because we're Australian, that type of thing. But it's been really positive. There's some comments you see on Facebook, because we're in the big Facebook chat groups and stuff like that, going, they're very negative, a lot of the locals. And these probably are non-investors, by the way. These are just in big chat groups where they're like, oh, the economy's tanking, all that kind of stuff. It's the exact same stuff we were hearing in Australia 5-10 years ago, because commercial, I'll quote one person. Someone said, you only go into commercial if you want to go broke. And I remember that same comment 10 years ago in Australia, because it was just unknown that all the myths of no capital growth, and we're getting figures for New Zealand, and it's looking, and the capital growth rates are basically quite similar to Australia for commercial long term. And why do they think it does get no capital growth? Is that a residential agent spitting this stuff out? I don't know. But yields are great. Our negotiation power is a lot better. That's in Australia. We're losing 80% of our deals because we want good yields. We want, the best of what we can get. But and then people aren't selling because they'll go talk to their accountant and they'll go, oh, the capital gains tax is going to make it not economically viable for you to sell. In New Zealand, it's a buyer's market for sure. I feel like we can dictate terms a lot more, at least comparably to Australia, and it's nice. It's it feels like we can get a good deal. And the more I hear these things about people being negative with the economy, as a buyer, you want more of that. You don't want them to say it's great, because then they're going to want more money for the property. We've got to buy well. That's the fundamental of getting into.
So do you think you can buy better in New Zealand than what you can in Australia at the moment?
Without a doubt, yeah.
So for those Aussies in and tuning into this going, oh, that sounds pretty good. Why, me, for example, I'm already thinking maybe I'd buy some in New Zealand. Why would I be in New Zealand and not here?
Well, look, the biggest difference is the lending. So your interest rates are probably 2% higher, maybe 3% higher than Australia.
Yep.
And you're getting about a 1 to 1.5% better yield. So the differential is not as good in New Zealand yet. And that's the key point. I look beyond just today's rates. I look at the rolling 10-year average, and there's no doubt New Zealand's coming down faster and harder. And because their interest rates are because their yields are initially higher, there's more fat in those numbers. And the lending ratios are lower as well. You can get 70, 80% in Australia, but work off 70. You're probably working off 50, 60 in New Zealand. So more cash, higher interest rates, but better yields, better long-term picture. And as an investor, you want to pick the market. So one way of picking the market is it in improving sentiment or conditions getting better? I see it improving better in New Zealand comparably, because Australia, it is what it is. Interest rates will slowly come down, but there's no, like you said, what's the current prediction? March, April next year. We thought they were going to be dropping in September and November this year. That ain't happening. So things aren't as improving as quick here, but I'm seeing a little bit more hurt on the streets with inflation biting. And again, as an investor, I'm like, we need this. We need more of that pain before interest rates come down. So New Zealand's already got that. So you're kind of ahead of the curve, like what you mentioned, Todd. It's happening sooner there. So as an investor, I feel like I can make quicker returns. And I myself, I'm looking over there. I love the idea of owning some, industrial property or a large format retail in Auckland, Christchurch, Wellington, one of the biggest cities over there. It's a diversity play too. A lot of our clients are onto their 10th property with Rethink. What, do we just keep buying in smaller and smaller cities, or do we go New Zealand? It's an exciting diversity play.
And I'm sort of already thinking probably need to speak to an accountant, but there's no stamp duty, no CGT, is that right?
No stamp, no CGT.
No CGT. So
if you're a property developer or trader, of course you've got to pay.
Yeah.
So if you're buying to sell within 12 months, then
you pay it.
Then you're paying it. But if you're underwriting a long 10-year plus hold,
yeah. So the thing is, if you create wealth in New Zealand, like, you know, you got to get back to Oz at some point. Yeah. You know,
we don't think you have it back, mate. We'll just keep it.
Just keep it all.
Sorry about that.
That's all right. But like, you know, long term,
you've got to keep reinvesting back in New Zealand.
That's it, right? You know, like, but long term sort of tax planning and estate planning, I imagine, has got its complications.
It does. Like, you know, silly example, but we've got a house in Greece where Airbnb it. We just leave the money in Europe. You know, it's just, do you need to get it all back to Australia at one point? Probably not, unless you're loading up on some big property or something. So, you know, you just diversify. And long term, you know, with all the political changes and tax, you know, changes, it's probably good to keep.
I reckon New Zealand's one of the safest places in the world these days. Was where a lot of American money's going, right? Because
would be. It's
the likelihood of if the balloon goes up, sort of New Zealand getting too impacted is.
Well, they are one of the most unique places on earth, just like Australia, is you can fix any recession with immigration.
Yeah.
There is so many people that want to live in New Zealand for good reason, and you just open the gates and rich migrants come and most
there you go. Make it easy. You need the right government, right, to facilitate that. But Todd, we always finish our podcast with burning questions.
Okay.
And the team over at Rethink's actually gone and knowing that we had a very important guest coming in from New Zealand, specifically went out there and there's heaps of them come in and the team's given me 5 of them. We'll get through them, I reckon, really quickly, just round out this podcast. Some of these people might go, that sounds a bit basic, but, you know, I'm still learning about New Zealand market, so I'd benefit from insights on it. As is Scott, you're always learning, no doubt, what's going on. So the first question is, how does NZ stack up against Australian purchases, risk associated for Aussie buyers? We've sort of covered a lot of that, but it's...
I think there are risks in New Zealand that you wouldn't necessarily... I think seismic was the obvious, wouldn't necessarily see in Australia, so I think that was one obvious one. And I think like any market, you really have to understand, you know, the drivers for the demand.
Yeah.
And how likely you are to see some competition popping up in your little sub-district. So, but I don't think that's different to Australia. I think that you'd find that anywhere. Risk-wise, I think I agree with Scott. The Reserve Bank governor came out and said we're effectively going to have to induce a recession. So it's not often you hear that, but he's done it. So we're in a technical recession on a nominal basis because we've had such big immigration, but on a per capita basis, we've been in one for, as I said to you already, a number of quarters, and that's really having an impact on businesses and on households. So as a result, we are going to see interest rate fall. There's no question in my mind. So that's going to drive the opportunity from a yield compression.
Yeah, on that recession piece, how long do you think the government or the Reserve Bank or the central bank will want to keep New Zealand in a recession? Like, because there's levers you can pull to accelerate out of it.
It's actually their mandate's between 1% and 3% inflation. That's it.
That's it.
So the new government took away the growth mandate and didn't talk about employment. It's just around keeping inflation between 1% and 3%. So we're at 3.3 now. It's trending down. It's almost within range.
What was it the previous quarter?
I think at its peak it was 7%, and it's been trending down. I think it might have been 4.6.
Yes. What did we top out at? 8? What did we top out at? 8 point something?
High sevens.
High sevens.
Yeah, so very similar.
7.6 from memory.
Yeah, there you go. So you're very similar.
8 points.
Yeah, and ours are sticking around longer than they thought.
Well, because what's your equivalent of the OCR? You've got funds rate here, isn't it?
Official cash rate.
Yeah, cash rate.
Yeah,
there's 4 something, isn't it?
Yeah, 4.45.
It's a bit sticky. Yeah. It's trending down, but not as fast as they like because all sorts of issues like even government spending's a big one they're blaming on at the moment, isn't it? That's all sorts of political things, but
the union movement's the biggest problem now. It's causing the biggest problems around inflation and building materials and costs and stuff. But anyway,
well, building costs are coming down for the first time in a long time, so that's positive for supply.
Yeah, I was talking to one of my clients today. Actually, he said they bid a project where they had cost numbers for 22, and the figures came in 10% less than what they estimated for 22, not including any of the contingency.
Okay.
So they're actually seeing
materials or labour or a bit of both.
Everything.
Yeah.
So I mean that just shows you how tough it is out there. So I mean that's not necessarily a great sign from an economy point of view, but obviously from a construction point of view, suddenly your feasibility for new developments makes more sense.
Yeah. We sort of covered this very quickly. What's the LVR in New Zealand market? A bit basic, but the LVRs are tighter on lending out there?
50 to 70, work off 60. So that's why I say to an Australian or a New Zealand resident, like $500,000 cash will get you into a decent property. You can do it with less, but you just want to be safe with the lending scenario because it depends on the asset class. Like Todd mentioned, there's a different ruling for industrial or big business type tenants versus if you're buying a mechanic in out in a regional area. So it's more cash required, and that is one of the potential things that could improve because the lending is much tougher than Australia. And it's like, being an outsider looking at Australia versus New Zealand, I feel like there's more room to improve there. The banks are almost overly harsh there. Australia, they've been a lot more bullish on commercial property. So remember, like, it's the trend that you want to buy into. If they're going to trend to lend a little bit more or be a little bit easier in the interest rate, there's a lot of upside in growth. So that's why I'd put my money personally into New Zealand because we're buying at the worst point. So it feels like there's just upside.
Can you invest in Aussie super in New Zealand?
It's a good question. I do not know the answer to that because...
Yeah, we should pick that up and...
Yeah, because all the Aussies we're talking to, it's generally either a refinance from a resi property, pull the cash over there, or straight cash.
Yeah.
And the New Zealanders, a lot of them have just refinanced. The big opportunity is those who've got like a big resi portfolio and they're just sitting on a dead portfolio which is negatively geared. They're selling them off, like supply is picking up a lot in the resi markets in New Zealand. And a lot of them are transitioning to commercial for the same reasons they do in Australia. It's actually going to help you in retirement rather than just be there for growth.
Yeah.
Very little cash flow.
There's a question here. It says, could an individual skip investing in resi property and go straight into commercial with 150K deposits in New Zealand?
I don't like that. Look, it depends on the experience of the investor. Like, I like working with investors that get investing. Like, if you're the first time investor and you've never dealt with a bad day on the stock market or never had a tenant, flood your bathroom, like, they're the little things that need to thicken your skin. Because if you go straight into commercial and lose a tenant, and then you've got a 4 to 6 month vacancy and you've got no buffers, you'll never invest again. You'll be so traumatized by that event. But if you're an experienced
So you need
investor,
some scar tissue.
You definitely do, yeah. And then you know how to problem solve rather than freak out. And it's easier said than done if you don't have the money to protect yourself. So 150 is a bit thin, I'd say, for the requirement. But yeah, or almost for that budget, you either go a small warehouse in Australia or just straight into residential in Australia because you can do a 90% lend and get a decent asset in resi.
So really, you still need a fair bit of dough to play in the NZ market. The question here is what kind of deposit you need to get started in NZ. If you're talking 60% lend, no stamp duty, which is... So your in costs are a lot less, but you're still going to need $500,000 to make it meaningful.
I'd say $500,000 is a minimum. I would have thought.
Yeah.
Yeah.
And you do get a decent asset for that. Like, that would probably be the feeling of a 1.8 mil asset in Australia. So you can get your freeholds. Not often. Mostly it's well-located strata for that money. But, you just want the quality. Like we always say in commercial, it's not about just going regional to get you need a good tenant. You need the right location. The banks are going to support it now and into the future. And sometimes a good quality strata is all you need for that budget.
Probably consistent no matter where you invest, right?
So,
Yeah. No, cool. Well, interesting, Scott, that you're out there doing what you're doing. It's good to get from the horse's mouth exactly what's happening out there. I'll sort of conclude with this sort of question, Todd. Fast forward a year and you're back in the studio. What do you think we'll be talking about?
I'll be getting sledged by you about the sheep again, mate.
Probably. But I'd just like I'd put it on record, I didn't mention sheep.
Oh, right, that was me, wasn't it? Yeah, just saying I was a Kiwi. That was bad enough of insult. I genuinely...
Too many Aussie investors, get rid of them.
Yeah. No, we're very, very happy to see Australian investors come across. No, I honestly think we'll be in a bit of spot. I think the way things are going at home, I think there's a real momentum to bring private capital into infrastructure, into development of all sorts of projects. I genuinely believe that interest rates will fall, the confidence will be up again, and we'll start to see things turn. I think immigration, tourism, student numbers, all those things will be positive influences for the economy. New Zealand will continue to do well. Look, we're not as big as Australia. We don't have the depth of capital here. We're not as wealthy. But in some ways, that's probably part of the opportunity, right? You can close that gap, and hopefully, Scott can keep it doing his magic, we can start getting the banks to lend a bit more, and we can.
So, but let's start putting some pressure on the banks. Let's get them up to sort of 70% being normal for commercial property. I don't sledge the banks. I like the banks, but I'm sure we can apply the right type of educational influence to maybe change and shape attitudes and behaviours to it. Right, but
70% loans at 5% interest. That'd be nice over
Happy
there.
days.
Yeah, I'll get one of those.
Yeah. Where do I start? So are you getting calls from Kiwi investors now?
Like, you understand?
Hey, hey, when are you going to set up a satellite office?
Dad jokes are getting worse. Sorry, guys.
Yeah, no, look, it's I've been really surprised by this. Like I told you, it was almost a bit of a why not scenario. Like we got asked. It's an adventure to set up something overseas, but it's actually turning into a serious business. Like we've got a few staff over there, and we're doing right now probably 5-6 deals a month over there. The goal is 10, by the way. Like that's just a per capita ratio on what we've been consistently doing in Australia. So yeah, if we're hitting those numbers, it's pretty decent numbers for New Zealand. And
it's good to hear.
Average deal size is around 3 mil as well. So they're not tiny deals. We'd like to get into the higher price points, and as I said, the buying's good, so the investors are saying yes to the deals. So that's
get in there quick before every other buyer's agent in Australia follows you out there, mate.
Yeah,
exactly.
That's what's going to happen. Hopefully, the guys at JLL are looking after your team, and I look forward to a fully expense paid tour. No, thanks, Todd. Thanks for coming out, mate. Todd Lauchlan, Managing Director at JLL New Zealand. I'm sure you can Google these guys and find out what they're doing out there. Scott, best way to contact you guys is?
Just rethinkinvesting.com.au or just Google.
Have you got a .co.nz yet?
We do.
Oh, yeah.
Right.
Just Google Rethink Investing NZ.
Yeah.
There you go.
The NZ email's got the NZ numbers. It's
and if you want to listen to another podcast, you can dial into the Toddcast.
Do you do a Toddcast?
I do. It's got about 300 listeners.
Really? How do I find how do you find Toddcast? You can syndicate this on it if you want. You know, is it a JLL initiative? Is it?
No, it is. Yeah, but I thought it was an original idea, but then I went through the podcast app and saw there's about 30 other podcasts on there. So you have to go Toddcast New Zealand, and you'll get me.
Yeah. I'll tune into that. Maybe I can. Maybe you can do all the sort of hard, heavy lifting for you. Just learn from this bloke. But,
head over there.
No. Good. Well, maybe we'll go out to New Zealand one day and maybe do a thing. We should do that.
We're there in a month, mate. Let's catch up.
Well, I should actually get you on, shouldn't I?
Yeah.
On the Toddcast.
On the Toddcast.
Leverage all this sort of Instagram following you've got.
Why not?
Well, thanks for tuning in, everyone. I hope you feel a lot more informed about what's going on in New Zealand. It sparked my interest personally. I need to get some more commercial property. I'm sick of resi stuff, as Scott knows, but maybe I'll have a little go in New Zealand. Let's watch this space. Thanks for tuning in. We'll see you next time. Until then, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.